The budget has been and gone, and the macroeconomic highlights of this week are likely to be the European Central Bank's latest policy decision on Thursday the 11th of March and two sets of inflation figures. They are the consumer price and producer price index figures from China on Tuesday the 9th, and then the producer price index data from America on Friday the 12th. Now you might think this all sounds a bit esoteric, but please bear with me. Stock markets ended February on a wobbly note, and one of the reasons why was an increase in government bond yields, exemplified by the UK's benchmark, the 10-year government gilt, for example. The yield on this paper has been going up, and its price going down, because markets are looking at vaccination programmes, ongoing monetary stimulus from central banks and ongoing fiscal stimulus from governments, and wondering if the result just could be a strong and, yes, dare one say it, inflationary recovery. If so, that could end a 25-year plus downtrend in inflation and usher in a totally different financial and economic environment. Such fears have been expressed before, and prior spikes in gilt yields have petered out over the past decade, but investors are on a state of alert all the same, and that's why these numbers could be important. In terms of the Chinese inflation figures, January's numbers were as follows, so you have a benchmark for February's. The Consumer Price Index, or CPI, unexpectedly dropped, actually 0.3% year on year, and the Producer Price Index, or PPI, rose 0.3% year on year. That was the first gain in 20 months, and that may be the more important figure. Also known as the factory gate rate, this could show if China is starting to export inflation around the world as it sells its goods. Meanwhile, the US PPI for all manufacturing industries rose 1.6% year on year and 1.4% month on month in January to give economists pause for thought. Let's see what February brought, as oil, other commodity and shipping expenses all rose and the dollar sagged. Bottom up, we have a long slate of scheduled company results ahead of us, most of them final full-year figures from large, mid and small cap stocks. Names which may be worthy of further research are as follows, either because of what they have to say about their own fortunes, their industry or the economy more generally, though please do note again that these dates can be subject to last-minute change. So we've got life insurer Phoenix, non-life insurer Direct Line and Senior on Monday the 8th of March. Standard Life Aberdeen, ITV, Keller and GameSys on the 9th. Another life insurer, Legal & General, as well as Spirax Sarco, JustEatTakeaway.com, Brickmaker Ibstock and National Express on the 10th. Rolls-Royce, WPP, Balfour Beatty and Playtech on the 11th. Before real estate investment trust Hammerson closes out the week on Friday the 12th of March. But for all of those, the stock that could just cause the biggest fuss in the week ahead is Morrisons. The grocer is due to report its full-year figures to the end of January on Thursday the 11th of March. Shares in the Bradford headquartered firm are a few pence lower than they were a year ago. Seems a bit ungrateful when you consider how important the company's been in keeping the nation fed and watered during the pandemic. However, Morrisons may have racked up strong sales figures, but it's had to contend with additional costs during the pandemic. January's trading update acknowledged that COVID-19 related costs would come in at £280 million, higher than previously thought. Well, the company also said it would repay £274 million in business rates relief, including £230 million in the year just ended. As a result, the firm noted it was likely to meet but not beat analysts' earnings forecasts for the year. When it comes to the results, they'll be initially judged on three headline figures. The first is like-for-like sales growth. Morrisons' Christmas trading update in January read well, as revenues grew 9.3% year-on-year in the three-week festive period on a like-for-like basis, excluding fuel and VAT. Shareholders will look to see how the last financial year ended overall and get any feel from Chief Executive David Potts as to how the new financial year has begun. The analyst consensus for the full-year figure is growth of 7.9% for the year just ended, followed by a 0.2% dip in the year to January 2022. The second figure is pre-tax profit, excluding exceptional items. Management has guided to £420 to £440 million. Now, analysts are forecasting a figure of £200 million, but that's after the £230 million rates repayment, so they're going for a number bang in the middle of the range. For the year to next January, the current consensus is £431 million, which includes the £44 million final rates repayment. And finally, attention will turn to the dividend. Morrisons already declared an interim dividend of 2.04 pence a share and a special of 4p, Analysts expecting a final payment of 4.75 pence a share. Going forward, the consensus is looking for increases in the regular and special payment in both fiscal 22 and fiscal 23. More qualitatively, shareholders will be pleased to see Morrisons announce in early March the extension of its wholesale supply deal with McCall's. They'll also be looking for updates on Morrisons' store refurbishment plans and its trends in its online sales, both via its own website and that of Amazon.co.uk. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.